Many traders see two peaks forming on a stock chart and immediately assume the price is about to drop. But treating every twin peak pattern exactly the same way is a reliable method for draining your trading account. Today, we are breaking down the exact mechanics of one specific highly profitable variation, the atom and atom double top. By the end of this video, you will have a step-by-step checklist to spot the shape, validate the setup using trading volume, confirm your entry, and calculate your exact price target. We will also cover a unique mathematical exit rule for this specific pattern that historically hits its target over 70% of the time. Sticking to a strict set of technical rules removes the emotion from trading and provides you with a verifiable statistical edge. Step 1 is visual identification of the pattern. You are looking for an upward price trend that terminates in two distinct, sharp, inverted V-shapes. These pointed spikes are known as atom peaks. This chart of Vulcan materials shows the difference. Notice the wide, rounded Eve peak on the left. In contrast, the two narrow spikes on the right are atom peaks. They must reach nearly identical price levels, varying by no more than 6%. These atom peaks are typically formed by a rapid 1 or 2 day price surge. The height and width of the pattern determine the strength of the subsequent move. Tall, narrow atom patterns average a 25% drop in a bull market, while short, wide setups consistently underperform. Once you identify two sharp, even peaks, step 2 is measuring the timeline between them. The statistical sweet spot for post-breakout performance occurs when the two peaks are separated by 5 to 7 weeks. If the peaks are spaced further apart than 8 weeks, the pattern's reliability deteriorates. Strictly enforcing these specific shape and timeline parameters filters out the messy, low-probability setups that frequently trap impatient traders. Step 3 is validating the pattern using the volume indicator in your charting software. This chart shows Teva Pharmaceuticals. Look below the price action to the volume bars. You want a heavy volume spike underneath the left peak, followed by a downward trend creating a U-shape. This volume signature proves a psychological shift. The heavy volume on the left peak shows the initial buying frenzy has exhausted itself, leaving fewer buyers to push the price up during the second peak. Step 4. Draw the confirmation line at the lowest valley point between your peaks. This is your absolute boundary. If you short before a daily candle closes below it, the price will reverse and rally 65% of the time. While false breakouts happen, the break-even failure rate is actually quite low. This happens when a stock confirms the pattern but drops less than 5% before rebounding. However, this failure rate is just 8% in a bull market and 11% in a bear market. The data proves that without a daily close below that valley low, the twin peaks are just a trap. The confirmation line is your primary defense against fakeouts. The final step is executing your exit strategy using the half-height measure rule. Standard chart theory tells traders to measure the full height of a double top to find their price target. But for this specific atom setup, that full height rule hits its target only 40% of the time. Instead, use the half-height formula. Take the highest high, like 35, and subtract the valley's lowest low, 24.88. That total height is 10.12. Divide by 2 to get 5.06. Subtract that from your valley low to get a precise target of 19.82. Switching to this specific half-height calculation increases your target success rate from 40% to a massive 72% in bull markets. Calculating this target before you enter replaces hopeful holding with a mathematically grounded exit plan. Let's review the workflow. First, identify an upward trend ending in two sharp, inverted V-shapes separated by 5 to 7 weeks. Second, validate the setup by checking for heavy volume on the left peak. Third, wait patiently for the daily price candle to close below the valley's confirmation line. And finally, secure your exit by setting a take-profit order using the half-height math rule. Following this exact sequence protects your capital from premature entries, filters out weak setups, and provides clear parameters for locking in your profits. Open your charting software right now, scan your watch lists, find a chart showing either a sharp atom peak or a rounded Eve peak, and let us know what you find in the comments below.